Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Been getting into talking about the markets and the economy, giving you kind of an update and outlook for 2022, as well as we talked a little bit about 21 and some of the changes in particular over the last few years and what that might mean. When you look at how strong we've had how strong the market's been, as Phil said earlier, about 20 back-to-back years of 20% gains. And you look at 2019 and with that, I mean, we've had a tremendous run. So the question, of course, as we've been talking about, what does that look like, though, going forward? What kind of things maybe we're doing really well in the past, but are they now kind of, as we talked about, these asset classes and sectors that are now overvalued, which would indicate, as you said, Phil, that there'd be some kind of a rotation where those would kind of fade back a little bit and other sectors and asset categories are going to rise up. Most likely, we're looking at, of course, small cap, we're looking at value, and we're looking at international there. Some other parts of this that I'd like you to comment on. One, on this next slide, consumer confidence, because this is one of those areas. You mentioned how important consumer spending is with regard to the economy, and of course, consumer confidence being an indicator of what that might look like going forward.
Yeah, I think this is one of our favorite indicators when you look at the market as a leading indicator. And the U.S. consumer, again, accounts for 68% of our economic activity as a country. And what we're seeing are some really paltry consumer confidence numbers, despite the stimulus, despite all the cash sitting on consumer balance sheets and low debt payments because of the low interest rate environment, Hank. We're seeing consumer confidence start to wane. And time will tell whether that's because of the outbreak of Omicron, whether that's something more serious of the inflationary pressures are starting to impede consumer spending. We're not sure, but the chart on the right-hand side here, Hank, is really the critical shot for us. And that is that when you see consumer confidence fall, usually there's a very high correlation to the S&P 500 performance over the next 12 months. And so something that bears watching as we start here. If Omicron fades, like it looks like it has in South Africa and in continental Europe, that it's spread more quickly, but it hasn't necessarily taxed hospital systems or we have fatalities jump as much. We'd expect some of that consumer confidence number to bounce back. But if consumers stop spending because they're worried about inflation or they're worried about the virus, Hank, that's a problem for our economy and it's a problem for the stock market.
Well, I think we just had an interview earlier this week with the head of the CDC. I think it was head of CDC, if I remember right, saying, and this was kind of stunning to me, that 75%, I think they said 75% of deaths as a result of COVID were people that had like four. I think at least it may have been even 4 comorbidities. So these were people that, in other words, and it's difficult to sort through all that and what it might mean, but if that's the case, then, has it been almost overhyped? And in particular with Omicron, where they've said it, though more infectious, much less deadly, much less hospitalizations and deaths as a result of that, and that actually could bode well in that it kind of gets us to that herd immunity all the faster in terms of if it does spread quickly and people develop more antibodies from it, but it's less deadly, so it doesn't create the stresses that we have on our hospitals and the like, it could actually be a good thing in the end.
Absolutely, Hank. Yeah. Absolutely, and I think that's where we're watching those consumer confidence numbers. And I think the one encouraging note from an investment perspective, taking the human element of the virus out of this, Hank, and just looking and just speaking at this point to the investment repercussions. When COVID first broke, markets were reacting on positive test cases, not hospitalizations, not fatalities. And I think the good news is for markets is we're starting to look at what's important, which is, are we seeing taxing of the hospital systems? And you can track that, Hank. We watch it every day. Johns Hopkins does a wonderful job of looking at ICU beds available, how many are COVID patients, how many are non-COVID patients, and then it's free capacity within the ICUs around the country. You can state by state or as a nation. And I think the good news is that we haven't seen, although we've been taxed in certain states at different times nationally, we haven't seen that taxing. And as a result, markets are now focused and fixated on the right thing, which is hospitals. If hospitals get taxed, politicians have to put in more restrictive activities. And then there's spiral downward on the economy and consumer confidence. And so Omicron looks like it's following the path of what we saw in South Africa, which is definitely it's spread more quickly. But at the same time, we haven't seen hospitalizations jump to where we're overwhelmed, nor have we seen fatalities jump as much.
Yeah, excellent there. You know, another part of this, so we've talked a little bit about the virus's effect, and of course the Fed being the bigger one in terms of concerns, but also in inflation. How do you see high inflation with regard to corporate earnings and the impact there and what that might mean as far as the markets as well?
Yeah, I think there's a distinct correlation, and you kind of see it on this left-hand chart. When you have high inflation, people are willing to pay less for future earnings or future dividends. And intuitively, that makes sense, right? If we have 5% or 7% inflation a year, a $2 dividend is worth a whole lot less in the future. And so we get a lot of questions, and Hank, I know you do as well, from clients saying, I remember back in the 1970s when we had price to earnings multiples at 8 times earnings. Well, we had 12% inflation back then too. And so I think when you have really high inflation, PE multiples come down. Right now, the markets haven't recalibrated yet. We're still trading at 21 times earnings with 7 inflation, with a 7 handle on inflation, Hank. And that's something that's a concern for us as we walk in. If these inflationary pressures don't dissipate quickly enough, the market will start to punish those high price to earnings names. But again, Hank, that goes back to the thesis that you can buy copper companies, you can buy aluminum companies, energy companies that are trading at 10, 11, 12 times earnings, where you have that layer of protection. So we think now's a great time to start rotating out of some of those technology high flyers that have carried the water for the market for the past 7 years.
This also, I've got a great slide here, Phil, and this is one of the areas I think that there's a lot of confusion with. I know talking to people, as far as bond yields and in particular, where we're now looking at a rising interest rate environment and what that might look like with regard to the bond market.
Yeah, Hank, the number one question we get from even our big institutional clients, endowments, foundations, and these are captains of finance that sit on in business that sit on these committees. When the 10-year bond yield is moving up, does that mean the end of the bull market? And the chart on the left, Hank, I think hopefully crystallizes this for everyone, is going back to the 1990s, a rising 10-year bond yield has actually been a great time to be invested in stocks. 10-year bond yields are rising because the economy is moving in the right direction, and folks are anticipating a higher rate environment to help taper back some of that inflationary pressure. And so if you look historically, you've had 20% gains during the midst of a rising 10-year bond yield. The other question, Hank, that we've been getting in pretty much every meeting that we've had with whether it be individual clients or those institutional clients of ours, is when the Fed starts raising rates, stocks down. And the chart on the right is really fascinating because it goes back to the 1960s, and it shows how has the stock market performed on an annualized basis when the Fed's been raising rates. And I think the key here is every single one of those bars is positive, Hank. So what that means is the Fed's raising interest rates because the economy is doing really well. So the fact that the Fed's probably going to make the first rate increase in this cycle since COVID hit our shores at the March meeting now, I think that's pretty much priced into the market. When the Fed starts raising interest rates, never in the history of the country has that broken the market. Again, it's the path, Hank, that's so important. The path and the pace, how quickly they tighten rates, that'll ultimately dictate how stocks do.
Yeah, this is one of those areas that, again, we're going to be watching, of course, very, very closely, but also, and again, getting ahead of it. This is a great time. You know, when you're watching out there and you're thinking in terms of how this might impact you, this is the time to be thinking of, how am I positioned in my current portfolio and what kind of changes might I make? How might I tweak that to position myself better for this coming year? And this is one of the areas too, Phil, with the as we're looking at these developments, as we're going to be watching this throughout the year, just staying a little bit on the nimble side. But I know I'm encouraging my clients, as we're doing reviews and stuff, we're going over their planning, making sure that they're on board with what's to come, what the expectations might be, and getting a little more defensive, in particular utilizing, sometimes it's fixed index annuities on the fixed side to help in that regard. thinking in terms of how we're going to keep that income stable no matter what's going on in the market. And of course, the stop loss overlay is a great strategy. Now, you got to be, caveat here, it doesn't go for everyone. I mean, there's some potential tax implications, but again, we're incorporating that in as a strategy as well this year. All right, we're going to take a quick break. Join us here. We'll be right back on the Retirement Report.